welcome everybody to the presentation today. As you can see that we have a very interesting topic today, the fintech startups and so-called regulatory sandboxes, and now also in addition to that, we will hear something about the role, the function of the whole ecosystem. So we have our presenter today, Professor Markose and Dr. Ariel. They are from University of Essex. And I think the paper is a part of a big research project that they recently maybe completed already or still going on. And that is, let me see the title. And so is a project funded by UK, sorry, what is the funding position body, Sheri?
ESRC and ICSSR. ESRC from UK and ICSSR from India.
Yeah, okay. So that's the joint. The project is about the UK-India Bilateral Trade in FinTechs and FinTech-enabled Services. And emerging trends and potential for growth. So I have heard something, from our annual conference, but today I understand you have already injected some new element, which is very interesting. So let me briefly introduce our presenters today. Professor Markose is a professor of economics and finance at the University of Essex, and she obtained her PhD from London School of Economics some time ago, I guess, and she is appointed as a member of the academic advisory group for central bank digital currency for the Bank of England and the UK Treasury. And she was also a senior consultant some time ago at the Financial Stability Unit of the Reserve Bank of India. And that is a very, I can imagine that was very important role for a central bank. And I have here, and Sheri is also the founding director of the Multidisciplinary Center for Computational Finance and Economics, which is a very attractive center. So we have, and I just I looked at Sheri's information actually yesterday. I understand Sheri has done quite a lot of work in computational finance and digital, which is very impressive. So we have Dr. Ariel, Nihan Ariel, and she is actually a research officer or research assistant working with Professor Markose on this project. And we have met in our conferences. We had some, I understood that you are doing a lot of data work for this project. So I think that's we have a very interesting topic. We have very experienced researchers here. So let's give the floor to Professor Markose. I understand Professor Markose is going to start, and then we will hear from Dr. Ariel, and then we will open the floor to the audience. We collected some questions, and we can start the discussion. Okay, the floor is yours, Professor Markose. Thank you.
Thank you, Hong, for your kind words, and welcome to all of you for the seminar today. So the topic is, what have we learned about the ecosystems for fintech startups and the role of regulatory sandboxes? So it's really the comparison between the role of ecosystems for startups, and especially fintech startups, and what role is played by regulatory sandboxes. And obviously, for reasons that Hong has indicated, these are perspectives from UK and India because it's funded by this 3-year project for which we have a large number of participants and COIs. Victor Murunde from SOAS, obviously, is one of our big luminaries on this project. And then we have Tanga Maroon, who's the principal investigator. Then we've got Philip Costo and Ahmed Khan, who is our other research assistant. So without further ado, I will tell you what the, trying to move the slides. Yeah, okay. So the objectives of today's talk is to analyze and evaluate the performance of startups, obviously within this framework of this rich, what I call the rich ecosystem. That's the hinterland from which these startups have been born or have taken root. And then some of them, a very small proportion of them, have got into the regulatory sandbox programs, both in India and UK. So we'll provide insights into the effectiveness and success of such programs for startups in the two countries. And really the objective is to compare what is the big role played by the ecosystem, because we know that only a very few or handful of these companies actually then go through the sandbox. The sandbox is, as we know, a regulatory framework that was pioneered by the FCA in the UK, and it only started in 2016. So that is going to be part of the reason why very few companies have gone through the sandbox, because when we consider startups from the year 2000 to 2003, and we're using the Traxin data, there were about 9,519 Indian startups, and of course, about 11,977 in the UK. And of these, only 45 sandbox firms were only 45 companies went through the sandbox in India, and 172. Sorry, it's the other way around. This is a typo in the UK. So 172 in the UK and 45 in India. So as you can see, it's less than 1% of all the total number of startups in this period. And once the FCA has introduced this sandbox framework, it has actually become very widespread, because about 50 jurisdictions globally have set up similar sandboxes. So they are considered to play an important role, and we'll try and assess what that would be. Of course, the ecosystem, the ecosystem goes back to the concept of the Silicon Valley that actually first rolled out the big tech companies, as we know, in California. And then history as we know it is over, but it's completely changed the history as we know it, and it ushered in what we call now the fourth industrial revolution. So these are variously called in different parts of the world: Silicon Valley, Silicon Glens, tech cities, what have you. So in fintech, I'm giving you a series of definitions what an ecosystem means. So an ecosystem represents a complex network of interconnections of businesses, platforms, consumers, and technologies that collectively contribute to the delivery and consumption of financial services. So it is stated that the significance of the incubating framework, or this what I will identify as a working definition, would require an identifiable geographical area. So what we're saying is that there is an identifiable geographical area in which all of this happens. So it's literally physically located somewhere. So despite the fact that ICT, or the information communication technology, mostly lives on the ether or on the internet in virtual environments, actually these companies have a very much of a physical existence within geographical areas, which I'll show you, in both the countries where the maximum numbers of such firms have congregated, and so on. So going back to very interesting, the idea of the ecosystem for startups or innovations is not new. In fact, I'm going to quote something from 1993 by John Moore in his paper called Predators and Prey, a New Ecology of Competition, because the concept of ecosystem, as you know, comes from biology. And what that means here is he's saying it's not just competition. The ecosystem is a very collaborative and cooperative environment as well, where you have to bring in frenemies, as it were, companies that are potentially adversarial or competitive, but actually they have to work together cooperatively to bring about, to co-evolve the capabilities. So his definition says these companies co-evolve capabilities around a new innovation. So obviously our new innovation in the fintech world is the ICT, information communication technology, the digital software based systems and so on. But they have to work cooperatively as much as they may be competing for customers and resources. So in my working definition, I have injected, of course, the idea of an identifiable geographical area where there's a growing congregation of new companies, specialist human capital, and funding entities distinctively covering tech. In the fintech world, they'd be distinctly covering tech applications to financial services, broadly defined. Now, broadly defined financial services, as I think was indicated in a previous work of ours, fintech doesn't even have an official categorization under trade or any such, more conventional frameworks, because the application of tech to financial services is yet to be identified. It'll be identified under a number of umbrellas. So it can be under business services, but relating to finance. It can be in the traditional aspects of lending, borrowing, or payment systems. But it can encompass now cloud computing, blockchain, smart contracts, um, insurance. So when I say broadly defined, the scope of financial services to which tech can be applied would be any and all of these areas that I just indicated. I have a problem moving my cursor. There you are. So I've got a nice set of graphics. Some of it is borrowed from a similar literature as to what is the fintech ecosystem look like. What we're saying is it has to combine a number of functionalities. So starting with the bottom right-hand side, what we have is the traditional financial institutions. So that is a very, very large area of the economy, as we know, in the UK, that occupies its contribution to GDP and world trade is the largest of its kind. And then in the UK, in India, we actually have a very large set of contributions, though traditionally India is not a big financial power. What it is as a result of human capital specializing in software and digital technologies, it has contributed in a very, very big way to the new tech revolution. I mean, the statistic that is often quoted is the fact that many of the CEOs of the Silicon Valley companies, as you know, Satya Nadella and many others, are actually trained in India in the big IITs, as they call Indian Institute of Technology. So we have a highly trained human capital in this field of technology. And of course, it's a marrying of the traditional finance to the technology that is contributing. So the technology, as you can see, that's specific to the fourth industrial revolution is like big data analytics, cloud computing, cryptocurrency, the entire social media, like the Facebook, the online version of all commerce, which was pioneered by Amazon, and so on. So the marrying of the use of electronic platforms for trading by bypassing the traditional intermediaries and so on is part and parcel of the tech revolution of finance. So, of course, the consumers, the financial customers, and of course the ecosystem involving all the startups. The fintech startups will be covering areas like payment, wealth management, lending, crowdfunding. This is not exhaustive at all. Capital markets, insurtech, and so on. They are these are the titles. If you look at the list of all these companies that are startups, they will be, they would refer to some of these words. And then, of course, the regulatory aspect of this whole ecosystem. So we're saying the ecosystem is the sum total of all of these things. It's not any one of these things, it's all of these things. And certain geographical areas have been found to be specializing or being able to bring together all of these aspects of the fintech ecosystem. And and I've added here the venture capital and angel investors and so on, which are new. In other words, what is interesting is some of the funding, even in India or in the UK, can come from, it's a cross-border flow. We haven't yet fully investigated that, but we find that in the digital transformation of economies, especially in the financial system, there's a massive amount of cross-border flows in the form of foreign direct investment and capital flows that are transforming bringing about the digital transformation of the financial system. So, so this picture should give us give us an understanding of all that is involved in an ecosystem. So here we have out of the 9,000 over companies, 11,000 companies in the UK, we have only selected those that have over 25 fintech startups. And this would be the list. London, as you can see, completely dominates the leaderboard. It has over 6,000 fintech startups out of the 9,000. Edinburgh comes second, outer London, all the areas around London like Richmond, Hounslow, and so on, include another 112. So you can see that then after London, there's a huge falling off of numbers of large conurbations of the fintech ecosystem. We have then Manchester, Cardiff, Tortola. If anybody's wondering what Tortola is, it is actually the capital of British Virgin Islands. So that has quite a representation here. Then Cambridge. So Bristol beats Cambridge. So I was somewhat interested, interested in finding that. And of course, Oxford, which is a biotech hub, is not quite a fintech hub. Then there's Birmingham, Brighton, Glasgow, and then of course British Virgin Islands appears in its own right as the whole island itself, as opposed to just the capital city. And then Reading just beats the cutoff at 25 fintech startups, and the remaining, that makes up the remaining 11,000 odd fintechs have each city has less than. Colchester has a few located in Hythe, which is around the corner from the University of Essex, and so on. So that's the picture in the UK. In India, on the other hand, the number of cities is so numerous, we had to take bigger geographical areas, that includes an entire state. So Karnataka is where Bangalore is. Here again, we put the cutoff at about 100 companies because we're now taking a larger geographical area. And Karnataka, Maharashtra is where Mumbai is, as you know, the commercial capital of India, and that dominates at 2,315, and then Karnataka 1,500 and so on. That's where Bangalore is. That used to be that is the tech capital, as opposed to the fintech capital. But as a result of being a tech capital, it's now attracted a lot of fintech startups. Quite numbering 1,500, number 2 in terms of the state-wise presence of these ecosystems. The NCT stands it's a short form for the national, the capital region territory. So that would include Delhi, that's a capital of India, and so on. And then Tamil Nadu is where Chennai is another big city. Telangana is where Hyderabad is. Uttar Pradesh is very well represented, and so on. So it goes right the way down. And then we have Odisha, Punjab, and so on. So these are parts of Kerala is where I come from. So it comes up at 207, sort of interesting, because that's an area that's along with Bangalore, Kochi, my hometown, for instance. It's quite well known for techies. Okay, now let me switch to what is the story behind sandboxes. As I've indicated, sandboxes is a pioneering concept of FCA, which is the Financial Conduct Authority of the Bank of England. As with a lot of things, the British are great innovators, as you know, both in terms of across the board. I mean, institutions in particular, apart from being the oldest democracy, as you well know, this is one of their recent innovations in terms of institutional development, and it is particularly focused at the problems that innovative firms face. What sort of problems do they face? Mostly would be called ambiguity in terms of regulation, and there's uncertainty for consumers and investors. When some product is an innovation, especially a financial innovation, there are lots of unintended consequences. As anybody well knows, the credit default swaps, the securitized bank assets, and so on, in terms of securitized mortgages. I would say they were great innovations of great merit, but they led to the great financial crisis. They were sort of on steroids. They just grew in a very large way without proper regulation. So financial products need to be carefully regulated. It is on par with, let's say, medical products. You can't let it rip into an unsuspecting population where without it having been properly stress tested. So in that sense, I will say that there are benefits to the regulatory sandbox from the point of view of the startup firm and for the regulator. So let me start with the regulator. What are the benefits? Because I'm actually an expert on systemic risk, and I've always been canvassing that products, innovations in the financial sphere, we should be careful. It should be carefully licensed and vetted, because on the surface it might look, from the point of view of the innovators, they're all gung-ho for it, but whether that is good for society as a whole, just like AI, in fact, the AI innovators, they're asking to be regulated because they know AI can run amok. Meaning to say, it can do all sorts of things, given that you can create deep fakes, you can create any amount of havoc in terms of bad, if it falls into the hands of bad actors and so on. So it has to be regulated very carefully, because now we have a combination of a financial product, because any financial product is possibly an investor could lose his or her savings. And then alternatively, if the financial products becomes a very large asset class like Bitcoin and cryptocurrencies, they could lead to systemic risk. So you can see that it isn't for just a innovator to put out a very attractive prospectus. The product has to be stress tested to see whether it is going to serve the public. It is because a lot of financial aspects of financial systems is part and parcel of the public infrastructure. It is a public good, especially when it comes to payments and settlements. And if you wreck such systems, because a particular product becomes highly successful, like cryptocurrencies or whatever, and then there's a large amount of intermediation. By that I mean our savings may be funneled into the wrong bubble economy. It can lead to systemic risk, meaning to say it could lead to the collapse of the financial system. At the moment, crypto products, as you know, is only 4 trillion. Many regulators may say it hasn't yet reached the point where it could become a source of a systemic financial crisis. The shadow banking in the run up of the 2007-8 financial crisis was 14 trillion, and all of it just blew up, and the taxpayer had to bail it out. So from my perspective, why sandboxes are important is for those reasons. Prelude for licensing to avoid the Wild West, as in crypto assets. I believe Geeta Gopinath, who's the chief economist of the IMF, said that at the last G20 meeting, that really we can't have another case of innovations in finance leading to another collapse of the financial system. And these things happen in the West. So that's the fundamental reason, my opinion, that I would support a regulatory sandbox as a prelude for licensing. The second thing is gatekeepers, they will suppress innovation. So this is the other side, the people who say that we shouldn't suppress financial innovation or any innovation, because if you have gatekeepers, if you have regulators come in, there, as from the Securities Exchange Commission, and this is sort of libertarian opposition to having a regulation rule a particular product as being worthy of being developed and have the public sector buy into it or use it as investment vehicles or whatever. They say, well, if you put in a gatekeeper, this could then create an unequal playing field between those that are included in the sandbox and those that are not, because we see that only a handful. Now, whether this is self-selection by the company, of course, we'll see, as Nihan will show, when you apply to get into the sandbox, your application may be rejected. So according to the SEC report of 2018, they said this might create an unequal playing field, especially if sandbox companies and those that end up using this as a signaling device, as we'll see, from the point of view of the startup company. Once you've got a stamp of approval from the regulator, the chances are you could convince your investors to put in money, more securely, in the sense of being, more secure with regard to the investment and so on. So, and the last point for the regulator is that it can aid innovation by reducing uncertainty, by testing it out. So you have some of the properties of an incubator, because you may, things that you may not have ironed out when you put it into the sandbox. The test, it'll prove to be a nice test bed to iron out some wrinkles or things that were problematic, and that could reduce uncertainty. Now, from the point of view of the startup firm, look on the other side of the panel here. See, the regulatory sandboxes allow fintech companies to test their products and services in a controlled environment. So that incubator principle might serve a purpose without being subject to the full range of regulatory requirements. So they kept their, before they are sort of put out into the general public, you get a safe space, a safe haven in which to test out your product. It provides specific privileges and freedoms to companies to explore solutions with actual customers in an environment for a limited duration. So there could be trial runs where you could try out with companies to explore solutions with customers, with actual customers. You can do these experiments in an environment that is not yet the actual market. Secondly, as it's already been indicated, once you have the insignia or stamp of approval from the regulator, it serves as a signaling device. So you can say to your investors, look, we passed the litmus test of the regulator, hence we are a safe product. And so you can see that could be very attractive. And the results so far says that sandbox firms raise 15% more funding after passing the sandbox. Now, our results, I'll admit, we need to do some more research. We don't get this rosy picture in the UK, surprisingly, which we'll come to in a bit. Okay, so what is the methodology? So we're going to use two methodologies. For the broader ecosystem, we will do a very large cross-sectional analysis, where what we want to know is the performance variable is how much capital is being raised by startups generally, and how much capital would sandbox companies raise compared to control firms. So that is going to be our basic performance indicator in terms of effectiveness of any of these um, uh, activities, i.e., this ecosystem as a whole. When we consider the ecosystem as a whole, as you will see coming up later, we will consider each of those ecosystems we have flagged out, i.e., the ones where London, we look at all those 27 ones in the UK, and similar numbers in India. We will see whether or not belonging to any of those um, geographical areas in particular does big matter. In other words, do you raise more capital if you're in the bigger conurbation or the bigger ecosystem of a state or the city? In London, for instance, are the bigger startups, when I say bigger, the ones that are successful in raising more funding, is it correlated, or is it is being in a bigger conurbation a positive causal factor, as opposed to having been through the sandbox experience? For the sandbox per se, we go into a more micro level um, 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 investigation. It's called synthetic control. It's become now very popular. One of these synthetic control experiments that was done was with regard to the research excellence framework in the UK. There was a recent study in 2021. They used synthetic control. They use synthetic control to see if the research outputs were better in the research excellence framework applied in the UK versus US universities, where there is no such nationally audited research excellence framework, as you know. So what happens in the research in this synthetic control is you have a number of these so-called treatment firms using and then we match it with a number of control firms that did not go through here in our case the sandbox experience, and then we work out. So the mathematics of it looks somewhat like this. Say we have J firms or units going from 1 to J plus 1. The convention is the first unit is the treated unit. We call it Y subscript IT. And all the other units, the control units for which this treatment did not take place, from IJ to 2, other potential controls, the potential comparisons. And the time is divided into two periods: the pre-intervention period T0 and the post-intervention period T1. So, of course, the total length of time is the pre-intervention period and then the post-intervention period. Because the sandbox is such a recent experience, and we are still in 2003. You can imagine we'd be lucky to get at least two post treatment or post intervention periods. So the T1, the post intervention period T1 would just have only 2 at most periods when the successful sandbox companies raised capital. The reason for that is obvious, because FCA only introduced it in 2016, and in India it came even more recently in 2020, 2021, and 2022. So bear that in mind, that the sandbox testing is still in its infancy. To do all of this analysis, we have these data limitations. So we denote the control firms as X subscript 1, and we denote by X subscript 1 the pre-intervention values and the performance variable of the treated firm, while X0 is the K into J matrix consists of the same values for the untreated units. And the synthetic control is a weighted sum of the latter that minimizes the difference between the treated and the non-treated units. vis-a-vis the pre-treatment performance using a two-step method. So we have a number of covariates in addition to comparison between. So the performance variable, the endogenous, the dependent variable is about the performance of the treated firms, and we're trying to match the non-treated firms. We take a weighted average of these. So the relationship we are interested in looking at is actually these weights. So J is the J equals 2 to J plus 1, remember, are these control firms. And then we have to, with regard to their performance for raising capital, and including other covariates, we have to find weights such that when the weighted sum of these these control firms will work as if it were a synthetic clone for the treated firm. So we're trying to minimize this deviation, the mean square error of the weighted control firms with regard to their various covariates and the performance of the treated firm, and then those optimal weights are the ones that we would need to crank out. So at the end of the day, what is good about this framework is that we can work out the average treated effect, and especially in the post-treatment period. In other words, how good was the Sandbox firm in being able to raise capital post Sandbox? And therefore, what we do is that we have to then create the YIT hat, which is the estimated performance of our control firms, of how much, given the weights that we have cranked out. Using those optimal weights, we will work out how successful were the control firms in raising capital opposed to the actual amount that was raised by the treatment firm. And this is then summed over all such Sandbox firms. So for every Sandbox firm, we will crank out the optimal weights vis-a-vis their control firms. So they have created the synthetic control, and then we work out how successful using those weights was the synthetic control capable of raising capital vis-a-vis the amount of capital that was raised, or the amount of funding that was raised by the treatment firm, the one that went through Sandbox. And so you can see that the paper on ref, and then it is normalized by some standard deviation term. So we cracked this out, we worked this all out, and the results will be given after Nihan will go through some of the finer details of the ecosystem and the Sandbox companies. You need to get a better idea of what the Sandbox companies look like vis-a-vis the larger hinterland of the ecosystem itself, of startups and so on. So I pass the baton on to Nihan now, and she will lead you through. Do you think we should take any questions so far before we go into some more details of the data itself?
Yes, if there are any questions so far, so Sheri is happy to respond. Any questions we have now? So from the audience, if you have any questions, maybe you can raise your hand. No, not yet. Sheri, do you prefer?
Okay, so we will move on, because if there are no questions at this point, because before we get into the data and then before we get to the results. Yeah. Okay, so Nihan, you can.
Yeah.
Hi everyone. I will talk about the fintech startups and sandbox companies both in the UK and India. Sheri, okay, thanks. Mainly on data. As Sheri pointed out, Financial Conduct Authority, in short FCA, is widely recognized for pioneering the first official regulatory sandbox creation. Since July 2016, applications from the first were accepted into the sandbox in 7 cohorts. It used to operate using cohort-based approach with a 6-month test period for accepted companies. But FCA regulatory sandbox transitioned onto an always open model, enabling firms to submit their applications anytime throughout the year, starting from August 2021. For UK, you can find the information number of applications and successful firms. About 29% of these companies proceed to test their products. When it comes to India, there are 3 regulatory bodies, namely the Insurance Regulatory and Development Authority, IRDAI, Reserve Bank of India, RBI, and Securities and Exchange Board of India, SEBI. All of them started their framework in 2020, which is later than FCA. IRDAI and RBI operate in 6-month cohort approach, as in FCA, where SEBI's framework didn't follow the same consistency. SEBI approved only 1 firm. The other applications were either rejected or withdrawn, and we have no information about what's going on in there. There is no data on the number of companies that apply to the Indian sandbox. The available information only pertains to the firms that were accepted for testing. Sandbox accepts applications from varying sizes of firms, regardless of their development stage or sector within the financial services industry. FCA and RBI are open to considering proposals from all types of businesses, while RADAI mainly focuses on the insurance business. For the ecosystem, the data is sourced from Traxon in April 2023 and provides detailed data on the fintech sector. Traxon data revealed a comprehensive list of 9,519 fintech companies actively operating in India, and the number for UK is around 12,000. In the UK, 11,328 fintech companies were founded after 2000. The largest amount of the UK companies were founded in 2018. For India, 9,221 companies have been established since 2000. The largest number of fintech companies were founded in 2021. However, the largest number among the sandbox companies, UK data is 2016, whereas India data is much earlier, it is 2001. In other words, India companies were established much older than the UK firms. Let's check the sandbox firms. The data gathered from the regulatory body's website and compare with Traxon database. In the UK, there has been 172 projects, and only the data for 128 projects, which belongs to 122 companies, were found on Traxon database. In addition, 51 companies out of 122 companies had the funding information. In the case of India, there has been 89 that we know. 41 companies with 81 projects were found in Traxon database, and only 23 companies raised funding. If we want to compare the UK and India a little bit more, the average raised funding in India, around $82 million, is larger than the UK, which is around $73 million. 11 companies acquired in the UK, and the number is only 4 for India. The public offering number is very close between UK and India. The 7 for UK and 5 for India. Sandbox companies of UK are mainly and heavily located in London. It's over 800 companies, 80 companies. In India, primary location is Mumbai, but Bangalore also accommodates a very high number of companies, sandbox companies. This figure shows the companies and their age for India regulatory sandbox data. Most companies were established after 2000. Recall that 41 companies are matched in Traction database and only 23 raised funding, which is shown in blue bars in this figure. To look more closely, the data is separating under 2 regulatory bodies. The figure shows the companies regarding their age and their cohorts for IRDAI and RBI sandboxes. Again, blue shows the raised funding data, which is available on Traction. What we can summarize in these figures is that IRDAI has more successful companies that proceed to test than RBI. Note that there is no company exchange between these 2 regulatory sandboxes. In other words, no RBI company went through IRDAI sandbox and vice versa. Companies that have participated in the IRDAI sandbox program have the opportunity to attend multiple times, whereas RBI information shows that each company attended only once. In our analysis, which will be shown later, IRDAI and RBI are kept separately. This figure shows the companies in the UK that went through the sandbox were founded before 2000, and there are very old and established 12 companies. But the majority of the companies that attended the sandbox were founded after 2000. To be exact, it is 160 companies. The largest number of the accepted companies projects are in 2018 and 2019 cohorts. FCL also allowed multiple projects as in IRDAI. And now, Sheri is going to share our synthetic control method results to you. Thank you.
Right, so now I have a few slides giving all the results of the empirical analysis we did. So in the IRDAI, as Nihan said, these are the companies, these are insurtech companies. And what is interesting is that to do the synthetic control, given that availability of funding is limited, we need at least 2 pre-funding dates and 1 post-treatment date. We need 2 funding events prior to treatment and at least one post. So we analyze 3 such companies in IRDAI, which is Policy Bazaar, Echo, and Digital Insurance. And when we put it to the synthetic control experiment, of the 22 control companies, only 8 to 9 control companies contribute to construction of the synthetic control itself. In the color, you see the weights. For instance, Policy Bazaar, these are the control firms, Turtle Mint, Renew Buy, One Asset. So we have PB FinTech, Toffee, India First Life, Liberty General Insurance, Zopper, and Cover Fox, for instance. So the 8 that had non-zero weights. So they are varying weights. For instance, Turtle Mint contributes to the synthetic control to the tune of 16%, Renew by 8%, etc. So that's what the yellow-colored weights for the synthetic control. So you understand what synthetic. It's made up of a number of control firms and then their significance or contribution to being a very good synthetic control is obtained by optimizing these weights, and these are the optimal weights that make them a good synthetic control. And so the various properties are how old they are in terms of since inception. So the age for, let's say, turtle mint is 8. It's an 8-year-old, and it belongs to the ecosystem Maharashtra and so on. And then the gender of the CEO, and then of course the total amount of funding they themselves raised. Now, ECHO also has these are the weights. Similar companies, so you wonder what companies were not included. One of the major factors of companies that were not included from our closer analysis is that the remaining, out of the 22, only 8, 9 contributed to the synthetic control. We found that the others had raised far less funding, as opposed to, let's say, Policy Bazaar that raised 674 million by 2023 since its inception. It is a 15-year-old company. Now, ECHO, for instance, is a 7-year-old company, and that also raised some substantial amounts of 527 million. And Digit Insurance also raised about 543 million. So these are very successful in raising funding, the ones that did go through Sandbox. And many of their control companies that didn't go through Sandbox were not that successful. So the ones that came closest to create the synthetic control raised, amounts like 132, but nothing as close to, 674 million, for instance. So what happens as a result of this analysis is that the average funding raised by the control firms, as you can see, is far less than those that were raised by the treatment firm or the Sandbox firm. This is 48 million, and therefore the result of this is that we'll see when we do you'll see when we look at the difference between the average treatment effect, in other words, when we take statistically how significant was the capacity of the treatment firm, i.e. the firms that went through Sandbox compared to the non-treated firms, you will see statistically in the case of the insurtech companies from IRDAI, they do pretty good. Now, let us see. I'll come to that in a minute. I just want to complete the analysis, synthetic control analysis. The Reserve Bank of India, the firms that went through the Reserve Bank of India sandboxes. Now, in the UK, you don't have these multiple regulators that are putting fintech companies through sandboxes. Now, the RBI sandbox companies are in the broader arena of fintech, whereas the IRDAI, as we just said, were insurtech companies. So these companies have a large number of control firms potentially that you can draw from, but only between 3 and 19 of these control companies, though we put a 91 control companies, only 3 to 19 proved to be relevant. In other words, have non-zero weights in constructing the synthetic control. So these are the weights. It is similar to what I explained in detail for the IRDAI. Now, what is of interest to all of us, is the bottom line. So I will do the one for the FCA. In FCA, we could analyze 5 of the Sandbox companies compared to 36 control firms. And then the Sandbox companies are the following. They are the Sandbox treated companies. What are their names? Yeah, Salary Finance, Fractal Labs, Money Dashboard, CrowdX, and Finicure. And then they raise between, Salary Finance raises 293 million, Fractal Labs only 4 million, Money Dashboard 14 million, 17 million by CrowdX, and 8 million is raised in total by 2023. Now, what is interesting is the control firms that didn't go through the Sandbox actually raise more capital. This ends up being the interesting result. So giving you a perspective on how the sandbox versus synthetic looks like, we give you an example from Policy Bazaar, which is the case of the IRDA sandbox company. So basically what we're saying is, here you see that Policy Bazaar, the blue line, and the treatment period is 2020. You see that in the latter years and in 2020, Policy Bazaar is far more successful at raising capital and its synthetic control, which is this red dashed line. So this is just to give you a more sort of closer picture of how the synthetic control works. Now, the bottom line here, this average treatment effects, what we find is in IRDAI, the case of the sandbox companies, they are highly successful, as we already indicated, and they're able to raise 52% more capital than their control firms, leading to this synthetic control construction. And for RBI, it is 34%. The sandbox firms are more successful. But in the case of UK FCA, because remember, we have this limited, remember the age of the UK, this was something that Nihan showed. The companies that did go through the UK FCA are much younger. In other words, they're newbies. And when their synthetic control is constructed from more established firms starting from year 2000, they seem to be at a disadvantage. They in fact do not raise as much capital. So we need to we're trying to widen the net. In other words, we're trying to look at we're going to try and get a more wider set of firms across the board, because this was in a way to proof of concept about, if we were to use synthetic control, what would the results look like. So the case of FCA sandbox firms to the UK being newbies compared to their control firms, when their capacity to raise capital seemingly hasn't yet fully materialized. So this is an interesting result and somewhat controversial, because remember, a previous study says that generally across the board, they didn't use synthetic control, which in my opinion is far more rigorous. They use a more coarse-grained method for of comparing the sandbox firms with control firms. And they said, sandbox firms raised 15% more capital. So we are looking closer into those results and comparing it with us, and maybe widening the scope of our sandbox companies, and not just focusing only on the very new, I mean, this is not in our power. I mean, if the ones that went through the FCA sandbox are really very recent startups, it's at this point in time, they haven't yet fully gotten up to speed. So now I'm going to move to the cross-sectional study. We're going to place the sandbox company within the larger ecosystem. So here is the Indian analysis. So remember, we've already said that the ecosystem, when we look only at funded, the ones that are, these were the total fintech startups, the ones for which there is data, is 350. Maharashtra is 335, and so on. So only 1,000 over companies have a full stack of funding data that we can use. So that is about 32% and 30% of the entire startup universe. It is quite substantial. It's a nice, it's a substantial number of companies that we have as representing the ecosystem across the board in India, like the different states. We said Karnataka, Maharashtra. This is Karnataka is Bangalore, is Maharashtra is where Mumbai is, and so on. Now, when you look at the number of sandbox companies, most of the sandbox companies also belong to the big ecosystem, so the big conurbations in Mumbai, Maharashtra, and so on. And this is the average age of the funded fintech companies, and so on. Now, what we do is when we run the cross-sectional and we do the cross-sectional analysis, these are our regression results. what you find is that by and large, it is entirely the case, almost entirely the case, at least in India, that the where you are born matters most of all. These are all the statistically significant variables for Maharashtra, that means in Mumbai area, Karnataka, Bangalore area, and so on, and Uttar Pradesh, Haryana, and Kerala. Oh, that's done been Kerala. Where I come from is also statistically significant. So is Punjab. So there are. I mean, but what is of interest is the sandbox companies, and not the role of sandbox in this big ecosystem story is really not significant. Now, so what we're saying is that it may contribute in an idiosyncratic way to the success of particular companies, but by and large, what matters is that you belong to the big conurbations, that you were born there. That matters the most. The smaller ones like Kerala, Punjab, these are all statistically significant. If you look at the p-values, it should have been highlighted, maybe with slightly different colors. But the point is that the RS is the regulatory sandbox companies are not statistically significant in terms of their capacity. The dependent variable is the amount of funding that's raised by these fintech startups. Okay, so when we look at the in UK case again, this is the data on the as I've already indicated. This is the data on the different ecosystems in London, Edinburgh, outer London, Manchester, Cardiff, Tortola, and so on, right? And then the majority of the sandbox companies, again, come from London. The average age of the fintech companies is about 7.3, 10 in each of these, and this is the total funding and so on. And what we find is that, of course, majority of the funding comes to companies that live in, that were born in London. And again, when we do the cross-sectional analysis of the role of ecosystem versus the role of the regulatory sandbox, what we find in the British case is that, again, the lion's share of significance of where you were born. If you were born in London, your chances are you are able to raise more capital. It's statistically significant. Outer London, Manchester to a lesser degree, Edinburgh very, very significant. Then Nottingham, right? Now, these are the big hitters by the looks of it. So you have to be born in any of these places. And then again, the sandbox experience within the bigger framework really is not statistically significant. But your ages, that's interesting. In the UK data, how old you are contributes to your capacity to raise capital. Remember, there was some indication about that already. So these are our results so far, and some of it is very interesting. And so how do we wrap up? So we say that having rigorously identified performance sandbox firms with control firms using synthetic control, we find mixed results, meaning to say Indian sandbox firms at both regulators, that is the InsurTech regulator and the FinTech regulator, which is Reserve Bank of India, they were successful on average, 54% for the InsurTech and 34% for the FinTech. And in the case of the UK sandbox firms, they were able to raise not 16, 14% less funding on average. They compared to their control firms, they only raised 14%. They were not very successful. They raised 14% less funding. So then we examine these fintech startups that went through the sandbox within the larger framework of all startups in these various locations. In other words, we're trying to find out whether the location matters more than the sandbox treatment. And lo and behold, of course, big becomes bigger. The bigger the conurbation of startups. This is a sort of power law, story. We know that more attracts more. There's always preferential attachment to being in places where there are already large numbers. These are called economies of scale, and sort of idea. So Sandbox process is not significant in both countries, but the age of the startup is significant in the UK. So to conclude, in the bigger picture, while Sandbox treatment can and may enhance success, it has yet to become a major factor. That's our bottom line. I mean, for obvious reasons, because Sandbox is a very relatively new thing. In the UK, it seems it's the newbies. There's a self-selection of the relatively new fintechs that are going into Sandbox. In India, we found that it was the more established ones that went through Sandbox, and hence they already have capacity to raise capital, and that gets reflected. So at this point in time, I think we will wrap up and take any questions if there are any.
Yeah, thanks, Sheri and Nihan for the presentation. I found this very interesting, particularly when we are getting to the empirical results. We saw some interesting contradictory results with between two systems, and so I hope we can read some issues from the audience. I know some colleagues are working in the fintech area, so I hope we have some questions. And I do see some familiar names. Guys, colleagues, do you have any questions? Or you can take a little while and to think about it. Sheri, maybe I can start. So I'm very interested in the results. So you use the two methods. You use the matching and check the ATT, and you use the regression analysis to cover more elements. So, and you found for the Indian group, so for the Indian group, you actually, from ATT method, you found that one going through the Sandbox regulatory process, then they are able to raise a little bit more financing capital. However, in your regression analysis, after considering more elements, you found not really significant results, even for those Indian sample firms. So that's one interesting result, and probably we would like to know more about it. So how to explain this? And for the UK firms, no matter which method you use, you didn't find any significant results in support of, the regulatory sandbox, the function of this. So that's the result. We need a little bit more understanding as we compare both Indian firms, startups, and UK, and also within India. Why do we see this, different results by using different methods? So that's one question. My second question is actually on the underlying theory. So think about, so we are talking about whether or not this regulatory mechanism or facility can help at least have something to do with the firm's ability to raise the capital. And that is very relevant for the firm, for startup to grow and to maybe survive and they establish themselves. So I think what is the underlying theory? So why do we see some? So what is the theoretical justification that if a fintech startup goes through this regulatory sandbox, then the prediction will be they are likely to raise more capital. So what is that? Well, I think we have not heard about this theoretical thing. So that's my two actually questions. One is on the empirical results and the inconsistency among those results. And the second one is the underlying theory, because we didn't find the sandbox function. But to understand this, what is the theory? What should be? So that requires us to know a little bit of theory. Thank you.
Thank you, So that's a very good question. I mean, there is a controversy, there is a big discussion going on. We need to say that Sandbox is all very well, but the actual effectiveness, where should policy focus its focus its concentrate on, right? Where should it, in other words, do we support ecosystems generally, or do we need to put our money into sandboxes? In my opinion, it shouldn't be an either or. I think both, because each is serving a different purpose. The ecosystem is essential. Ecosystem is now a well-established concept, as you know, in the case of any sort of big industrial innovation process. You have to be part of, you can't be suddenly one solitary company, someplace. You have to be part of a larger ecosystem. By that we need, because it has economies of scale, it has the trained personnel will congregate there, it will generally create these positive spillovers. So being a tech company out in the wilderness doesn't seem to have, isn't the way forward. So in many jurisdictions, they create what are called tech companies, tech cities. The government gives a lot of sweetness, as you know. They might even give cheap electricity. I think in Kochi, where I come from, they give all sorts of sweetness for tech companies to come to a certain geographical area. So without a shadow of a doubt, that is the overwhelming result here. We are saying that, look at London. Everybody says, oh, we should level up. We should have Edinburgh is doing very well. And that was an interesting result, right? That Edinburgh, not so much Cambridge, Edinburgh is doing very well. So this result, in our opinion, is actually the first of its kind at this very in-depth level, right? Where is the action? What matters more, right? The comparison between ecosystem and sandbox, it hasn't been done, but it has been implicated in many discussions that the sandbox is all very well, but really you have to be part of an ecosystem. I think that's a no-brainer, right? It's not either or. All sandbox companies, actually, most of them belong to the big ecosystems, right? They belong to London, or they belong to, in India, Karnataka and Maharashtra and so on. So the first question a company decides is, where is it going to be located? And that decision overwhelmingly seems to be big attracts more, big becomes even bigger, or, rich become richer. This is called the Pareto law of the world, right? It's called preferential attachment. You attach yourself to hubs that already have a lot of connections. You don't go and attach yourself to the periphery where nobody's there, right? Because these are all parts and parcel. This is all part and parcel. So that is coming through overwhelmingly. I think that is, I would have been surprised if it wasn't the case. And the second thing, of course, is that I'm not saying sandbox is a bad idea. I think the way the Indian companies have done better than the UK companies, because the age, Indian companies were mostly born in 2000, as Nihan showed. For whatever reason, Indian companies that went through Sandbox were established 20 years ago, whereas the ones that went through Sandbox in the UK are relatively young. So they haven't yet reached their full potential. That is my reading of the results. But I think I think we have another question there from Jaideep. Shall we take that?
Okay. Right. Thanks, Sheri. Thanks, Nihan, for very interesting research. I'm just to me, like there's a couple of thoughts that come when I listen to your analysis, and I'm wondering if it's to an extent it must be restricted what you can ask, what questions you can ask based on the data that you found, but beyond the whole question of the data, I mean, if you had the choice, what would you be looking for performance for a firm that goes into a sandbox? I mean, would it really be the fundraising, or would it be something else? Because I mean, I suppose the performance, the purpose of the sandbox is a little bit different from the purpose of an ecosystem. And in a way, the whole point is that the regulator is protecting them from regulations. So, what is basically what what is a measure of success?
You mean to
for a
say the regulator
sandbox?
is giving them a little safe haven for the
Yeah.
moment?
Yeah.
I would say do not despair. I think the British regulators have done the right thing. You should actually prefer younger companies to go through the sandbox, not the more established ones. See, the Indian situation is the more established ones. Maybe they had it isn't. I was told by somebody, one of our alumni who went through the sandbox. She said it is not an easy process. They had to bring in an external consultant to help them go through Sandbox. It is a little bit of, there's a lot of, this little money that you have to sink in, and time, especially when you're a startup. What are the chances that, the CEO has time to, make time in his heavy schedule to put themselves through Sandbox? They had to get an umbrella company to help them through the Sandbox. It wasn't an easy process. But generally, I would say yes. If the regulator is putting companies through Sandbox, put the newbies through the Sandbox, not the established ones. In India, it was the other way around. So I think it is only a reflection of the fact that the ones that went through Sandbox in India are more established, and therefore their capacity to raise funds was more keen. Whereas I would say in 3 years' time, maybe the ones that went through Sandbox would not show this negative result. So I would say do not despair. This negative result you see right now is only because the youth of the ones that went through the Sandbox. But it was the right policy, in my opinion. They should put the newbies through Sandbox. Do you see the logic of that? But but we're trying our utmost to widen the scope of the Sandbox companies, because we really need, even though, so out of the 40 Sandbox companies in India, we only have very little data that are funding data. Now we're trying to expand that. We need to get at least 10 or 12 to be a good selection. We have no problems with the control firms, because there are umpteen control firms that raise capital, and we have data on that. But it's the Sandbox companies itself. We really need to widen that sample. We will do that when we hit the magic number of maybe a dozen in each country. Then I think we are in a better position. But I thought generally the results, nobody's done this in-depth analysis. I don't think. We didn't find any literature that went, because Thangamarun was saying, there is this sort of, people are saying, oh, why Sandbox and all that? The ecosystem does the job, right? It is, in truth, that is the case. Where you're born is most important, in your capacity to raise capital, because these are all increasing returns to scale stories, right? More attracts more. That's going to be the law of the world. That is the law of the world. Rich become richer, right? So that is the story for today afternoon. We're hoping that we can raise the sample size for our synthetic control. I was quite impressed by synthetic control. Again, it is all a lot of work. But when you look at the other methods of doing this control, analysis of saying treated and non-treated, the synthetic control takes a lot of control firms and make them as close as possible to the treated firm. Whereas the coarse graining, I don't know whether you guys have done this, it's not really my forte, but the coarse grain controlling, you literally throw in anything in the kitchen sink. You don't do this very rigorous comparison. This is my opinion. I don't know, but you pay a price for that, because then but it's not, our problem was not that we didn't have sufficient control firms. As you saw in the case of FinTech, we had 92 potential control firms. That wasn't the problem. The problem is we need more data on the firms that went through Sandbox, because they're newbies generally, and the data on their funding rounds. We need some time series on funding rounds, as I said. That was the hard bit. We're hoping just now, by Googling and everything, we could get doing some little bit of web scraping. We may be able to up the numbers. So come back, we'll have a paper ready, hopefully, the written up version coming out pretty soon. But yeah, so it's been very useful. This is our first time that we've shown these results. The results literally we cracked out last, the other day. You always need a deadline.
Yeah, that's really good. Actually, I think you are the extension to the ecosystem, and the results you got, actually, I think is very interesting. And I have actually another query, and that is, I know the project is a comparison between UK and India. In respect, from the perspective of fintech, etc. But I wonder, so you do that separately, both in your matching and in your regression. So I was thinking, what happens if you pull them together? And so if you first pull them together and see the results, and then you separate them and you got the different results. And by looking at the differences among those results, probably you can identify more things that can explain the differences, for different systems, for the two countries. And that is consistent with your actually ecosystem argument, I think.
That's very interesting, this pooling thing. But I thought one thing, because it's also part of our wider research, is we want to see where the money is coming from. So at the moment, you notice in our cross-sectional analysis, we're only looking at the location, we're looking at the age, and then that's as far as we've gone in the cross-sectional. And of course, whether they went through Sandbox or not, right? Now we're going to add perhaps how much money came into each of these locations, because we've got foreign direct investment location data, right? That would be interesting to see how much, again, where is all the foreign direct investment going in terms of, new startups, in terms of funding, venture capital. So, but that requires a lot of painstaking data analysis, to where is all these venture capital money coming from, and so on. So we'll try and do that. But obviously, for the results for today, we just wanted to get the baseline, what I call the baseline results. Is location important as opposed to Sandbox? That was the baseline objective for today. So we can think of other things. The pooling, I think, is a very good suggestion. That's easy to do because it's only a question of pooling it to putting it. But then you'll have so many locations. You'll have all the locations in India plus the locations in the UK. You understand the independent variables will be quite a few. So we have enough data points because we've got about 1,000 over companies. So we'll check it out. We'll check out the pooled analysis, and yeah.
So
anything else?
So colleagues, do you have any other questions or comments on this very interesting topic?
Ahmed, do you have a question?
No? Ahmed, maybe you can add something in response to our
Ahmed, do you want to add something?
Okay, great. So no, nothing particular from my end. I think everything that I had in mind has very well been covered by Sheri and of course Nihan. I think there's some good questions raised between the comments that maybe if you want to see some additional variables, like Sheri said, where the funding, the comment that said that maybe if you want to see some additional performance variables or funding, see just what sort of an impact regulatory sandbox has had the performance of fintech firms. Yeah, that's Jaydeep. I think Jaydeep was in that comment. Definitely there's something that can help us expand our research further and see just what sort of objectives we're dealing with and how well those objectives are done.
Okay, thank you. Yeah. Nihan, sorry. Do you have anything, Nihan, you think you can add to whatever we have discussed already?
Not particularly, no.
Give me more data, correct? You have no idea how much we struggle with the data. It is. So we were surprised. On one hand, because it's a huge cross section, and then when you sort of dig deeper, you need to include in a regression, as you know, it has to be, we had to eliminate lots of companies because they didn't have enough time series. We say at least 2 pre, 1 post, otherwise it's too ropey. So we went through we went around that block many times, but on the whole, I think we've got the baseline sorted out. We've got the basic results. Now we know where to go, where to look for more data, etc. But so it's all thanks to Nihan and Ahmed. Thank you so much for all the hard work, and hopefully we'll polish this up and have a nice paper. Yeah. Thank you, Hong and Jaideep for comments, and thanks to everybody for attending.
Yeah, thank you very much, Sheri, Nihan, and Ahmed. I think it's very interesting. I learned a lot, and I hope we can continue this discussion when we meet next time. For example, Sheri, you should tell us how we consider ref. The next ref is coming. So
No, there is the paper already, Hong. It was most interesting paper. So the synthetic control, what it helps you do is you can take, groups that you're interested in understanding their average treated performance. So they took Russell Group universities. You understand? So you can slice and dice all your synthetic control results into different groups to see which group. Like, for instance, we want to see, look at InsurTech versus FinTech companies. InsurTech companies were doing better than the FinTech companies, because I think FinTech companies are under far more competition, to make a little bit of money. I think competing against thousands of new startups. So they were less successful. They were less successful at raising capital compared to InsurTech companies. So things like that. So the question the ref paper asked was, are the Russell Group, more capable of producing more papers in 4-star journals? You can look at performance in all and every way. We only looked at generic capacity to raise funding. We could have looked at other things. How many were IPO'd? But the problem about 0-1 variables doesn't work very well with synthetic control, because you IPO'd only once in your life, right? Whereas, of course, funding you can get all throughout. But again, that is quite, it isn't like you get it every year, like GDP or every year. Do you understand? So there are issues like that. But
I know what you are saying, Sheri, in terms of the UK, but now I'm thinking about your ecosystem. So we have REF for the UK. So what about the Indian firms? So that we can really get to a point where we can say this is really the ecosystem thing. And so that's something I was thinking about. But thank you, Sheri, for your work, for your team's work effort. I think this is a very interesting project, and I hope, maybe next year you can present another version of the project. And thank you very much. Thanks for the participants. Good to see you. And if there's no more questions, I think we are already, 2:30 over, a little bit over. And I will close this session. And thanks everybody, and enjoy the rest of the day. Bye.
Thank you.
Bye. Thank you.